So another week at Nifty, and we are in the week of March 11th. Here is a quick rundown on what happened in Nifty. First and foremost, Nifty, after a long time of consolidation, did come down by 2.1%, but it still closed above 22,000 to close at 22,023. 19 advances and 31 declines. So clearly a little pressure in the market. FI is sold for 884 crores and DI is bought for 14,146 crores. So still net positive inflow into the market. Now coming back to the part which we always cover is one quote which tells a lot about stock market. So this time it's Warren Buffett. The stock market is a device to transfer money from the impatient to the patient, and especially in the downtrends, because what happens is when there is a downtrend, people panic, they sell their stocks for cheap. But if you're a value investor and have done your research well, then nothing to panic in this downfall, because this is hardly a downfall. So stay invested, and that's what exactly this quote states, that stay patient when rest everybody is being impatient. Now, from an industry perspective, what we saw was energy had a huge run up in the weeks prior to the last one. So definitely it got a major beating. It came down by 6.75%. Metals down by 6.79%, and the same case over there, that metals had been having a very good run up, so it's down by 6.79%. IT up by 0.5%. So that's how the sectors were. Now in terms of what really happened in the market, obviously SEBI had raised some concerns that there's some bubble in the market, and yes, of course, there is a lot of trading happening, and especially in the options space. So SEBI wants to protect the retail investor, but retail investor is always wanting to try it out as a casino. So one of the things that SEBI also had on its radar was to make sure that mutual funds stress test themselves, that if a crisis like 2008 Lehman Brothers happens, then how much time it takes for the mutual funds to liquidate their capital and give it back to the retail investors. So this week was a stress test for that, and the results are out. So that was primarily the news in focus. And of course, it's a month for advanced taxes. So that's another factor that's there in the Nifty. Now, what we also did during this week as the market came down was to look at a few stocks and identify if we can look for picks which are in the value space. So, our approach to finding a value pick is that something which is either expected to grow significantly or is already an established industry but is now demonstrating a consistent growth. So the two stocks that we came up with right now are Vadilal Industries and Jubilant Industries. Let's look at their numbers, and then also switch to screener to see and how these have been performing. So let's start with Vadilal Industries first, uh, and Jubilant Industries. So if you really look at it from a PE perspective, what's very important about both of these stocks before we get into the numbers, specific numbers, is that the profits are growing significantly year on year. So there's a consistent growth. Now both of these are established industries to a certain extent. They're not new companies. Both of them being more than 20 years old. In fact, Vadilal is more than 100-year-old company, and the market cap is also significantly high. But what's most important is that their profits year on year in the last 5 years has grown, and that's what's given us the confidence that if this profit growth continues, then it will be good. So what we're seeing over here is that Vadilal is trading at a significant discount. Its current P is 16.8, whereas its 10-year median P has been 25. And the fact is also that in the last 5 years, the company has genuinely turned profitable. It has launched a few products which has started giving us it to tap into a market which it did not have access to earlier by being in the premium segment. Jubilant Industries, which operates in the polymer and the agribusiness, is also showing significant growth in profits, and at the same time its P is still at a very reasonable limits. It's at trading at 27.6 versus a 10-year median P of 16. But if we really look at their profits, they're humongous. The 5-year profit CAGR for Vadilal is at 44%, Jubilant is at 72%, and the trailing 12 months profit growth is also indicated at 65 and 51 for Jubilant. So it's really good numbers, and these are established industries. The PEG ratios are at very, very uh, aggressive 0.38, which gives it a very, very good valuation from a growth to a PE ratio perspective. Debt to equity is also fairly under control. If you really switch over to screener for a minute and then look at how the Vadilal has performed, if you really look at it, the net profit over the last 3 years especially, it has moved from 45 to 96, and it is now at 147 for trailing 12 months. So if we really look at it and extrapolate the numbers for March 24, what we can expect is that this number will go for the March quarter, for the March 24, that is the closing of the year, to 125 130, which gives it again a very good growth of around 40% year on year. So we are quite bullish about it. Um, Overall, the stock is looking very decent. And if we really sum it up, what we are observing in case of Vadilal is that the overall ice cream market is expected to grow at 17.6% CAGR until 2028 because of more disposable income and urbanization. And Vadilal is in a position to establish, to really dip into that disposable income wallet. And its profit growth, as the numbers indicate, are at 44% in the last 5 years. And it has also launched products which are in the premium space, which gives it access to more profit. And it's primarily the launch of Government Naturals has established itself to play in that segment. So definitely a product line which gives it, which makes it more profitable. And it holds 16% share, and primarily in the western region, and 16% comes around to 20,000 CR. So we have a fairly uh, 16% of 20,000 crore market. So it's a fairly well established player, and it's growing in the right segment. One of the concerns that we have about it is that its price to free cash flow ratio stands at 123. But given the fact that the profit margins have increased from 14 point to 19.8, we still believe it's a stock which is worth dipping into. We as investors, and we as who's studying the market, have started building positions in it. Now, depending upon how it shapes up in the next few quarters, especially in the quarters when there is winters, how it shapes up, we will build positions further. But definitely a stock which is worth considering. The next one being the Jubilant Industries. Let's look at what the screener says. Now, it's both in the agri and the polymer business, and if you really look at it from a profit margins perspective, it's growing from March to 22 to March 23. It moved from 54 to 62. Now, trailing 12 months is not looking very comfortable, but definitely as time progresses, I think this quarter might turn out to be very good. From a quarter on quarter perspective, also what we are seeing is that there is growth, although there are a little bit of headwinds in terms of net profits. Uh, Now, this minus 23 might be a result of some write offs that they have made. So, we are tracking this company. We're not starting to build the positions, but definitely a company which we are studying further. Maybe we'll start dipping into it. Now, if you were to summarize it, why we are feeling so confident about Jubilant Industries is that the polymer market in which it operates is expected to grow at 12 to 15%, and the agri product segment is going to grow at 5 to 7%. Now, 60% of the revenues are coming from polymers, which is a high profit margin business, and 40% is coming from agri products. So, it's in a position to actually uh, definitely increase its profit margins and even increase in the market segment. The sales have grown significantly at 39% in the last 3 years, and various government initiatives which focus on organic products, organic farming, definitely make Jubilant Industries a leader in that space. So that can help it grow further. And its brand Ramban, which is having a 44% market share in Uttar Pradesh and Uttarakhand, with 54% market share in the core areas of West Uttar Pradesh. So it's definitely an established brand and it's growing. And overall, the company ranks number one in India and two in globally for the polymer product that it has, which is used in the automobile tire cord and conveyor belts. So that is another space in which it is expected to grow. And given the fact that it is a leader both in Indian market as well as in the global market, there is significant room for growth. So these are the two companies in which we are starting to take note of and establish positions. So overall, that's where we are looking at currently. We're studying more companies and figuring out which companies are the right ones for during this fall. These two companies have made it to the list based upon growing profits and their current valuations. We expect a little bit more pain, I would say, not pain genuinely, but a little more rationalization on the Nifty. And March might still see volatility till it settles down in April. Elections have been already announced, so again, by May there would be a little bit of anxiety. But March, there might be more opportunity to buy, is what we feel. Overall, not a very bad week at the Nifty level, but definitely the mid caps and small caps have taken a beating. We do believe a little bit of that trend will continue. I'll see you in the next week, wherein we cover more details from the stock market, and maybe during the week we will release a few short videos which will have very specific stocks. Bye for now.